Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Market Rotation and Buy-Side Framework Explainer. This video presents a direct informational narration of the source document. So right now, we're seeing the major U.S. indices pull back a bit from their historical highs. But instead of panicking, capital is actually just getting smart. We're watching money shift away from overheated sectors and seek out safety margins in mega-cap tech and AI software. Today, we're taking a highly structured, data-driven look at exactly how this money is moving. We'll kick things off with macro rotation and geopolitics, then look at technical resistance and sentiment, dive into the semiconductor and software rotation, explore platforms, lithium, and data, touch on fintech credit and utilities, and finally wrap it all up with a buy-side probability framework. All right, let's jump right into part one, macro rotation and geopolitics. What's really fascinating about this current pullback is its anatomy. The major indices retreated from their all-time highs, sure, but with only mild losses. There was absolutely no widespread panic. However, high-flying sectors, think semiconductors, optical communications, data centers, they underwent a fairly broad correction as capital essentially got a fear of heights. We're currently in a phase of what you might call high heat cooling mixed with leader absorption. Basically, funds are rotating incredibly rapidly into AI software applications and mega-cap tech, just for that added layer of safety. And look at how fast geopolitical news just whipsawed the market. In the pre-market, we had a lot of optimism. Indices were getting pushed higher by reports indicating a U.S.-Iran consensus on gradually reopening the Hormuz Strait. But then, intraday, Iranian state television added some stringent new conditions, including demands for U.S. war reparations and requirements for ships to submit detailed declarations to a newly formed Persian Gulf Strait Authority. By the close, indices dipped slightly because the market realized, okay, we need to wait for concrete confirmation. The core pricing point here isn't the flashy headline itself, but whether the negotiations are genuinely moving forward. To put this geopolitical risk into perspective, just look at crude oil liquidity. It has dropped significantly, with open interest falling to its lowest levels since August. Because of frequent stop losses, the market is highly unpredictable right now. For example, right before the recent news broke regarding the Strait, a massive short position of nearly 10,000 contracts, worth a nominal $920 million, was opened. When that news hit and oil prices plummeted, that specific position yielded an estimated $125 million profit literally in an instant. It just perfectly highlights the severe volatility we're dealing with.
And that brings us to a really critical buy-side maxim. In news-driven markets, small capital becomes fuel for volatility. When you have a market dominated by sudden news and anticipated events, extreme trading risks are absolutely present, and smaller funds just get completely swept up in the turbulence.
Moving right along to Section 2, Technical Resistance and Sentiment. So quantitatively speaking, the QQQ is hitting a massive resistance wall right at the 700 mark. And interestingly, it hasn't yet retraced to its 5-day moving average. And the S&P 500? It practically touched its cyclical ceiling. It reached 7385 intraday, which is literally just 8 points away from a previously identified cyclical top range of 7377. Now, while the AI earnings upgrade cycle absolutely provides long-term fundamental support, these short-term technical conditions are telling us the market really needs to cool off, especially with the upcoming season. Quantitative models are also indicating that investor sentiment has entered a euphoric zone following that historic rally from the March lows. But, when the market gets this euphoric, it doesn't automatically mean a crash is imminent. What it does mean, though, is that large-cap tech is historically favored to outpace smaller caps. Historically speaking, from 2012 to 2023, following these euphoric sentiment phases, the S&P 500 outpaced the small-cap Russell 2000 by an average of 178 basis points over the subsequent 3 months. So the structural data really favors large-cap tech going forward. It's perfectly summarized by this rule. Fundamentals determine direction, technicals dictate if you can still chase the short term. Euphoric sentiment alters the forward odds structure. It means that while the long-term direction might be totally intact, your immediate risk-reward ratio for chasing those highs has definitely thinned out. Let's dive into Section 3, the semiconductor and software rotation. We saw the Philadelphia Semiconductor Index visibly pull back, dropping 2.72%. Funds had been so aggressively piling into semiconductors that it pushed the weekly RSI to its absolute highest levels since 1999. Naturally, that triggers a need for technical repair. Think of crowded call options like a stretched rubber band. Dealer hedging stretches it further and further up, but the second the buying stops, that support completely vanishes, and the rubber band snaps back hard. That's exactly what we're seeing in this rapid drawdown. ARM is actually the perfect case study for this vulnerability. They beat their current earnings and next quarter revenue estimates, but the stock still plummeted over 10%. Why? Because at these sky-high valuations, the market literally demands perfection. When management just highlighted some supply chain and cost uncertainties for their new AGI CPU, the market's focus instantly shifted away from new product growth right over to execution difficulty and profit quality. It created heavy technical double-top pressure that just erased those short-term gains.
But in total contrast to the semiconductor pullback, AI software applications have seen a really strong rotation upward, heavily catalyzed by solid earnings. Datadog posted 32% year-over-year revenue growth, crossing over $1 billion. AppLovin showed a massive 59% revenue growth and pulled in $1.2 billion in net profit. And Fortinet, they surged on 20% revenue growth and a record free cash flow of $1.01 billion. So it's strong revenue, profit, and free cash flow metrics that are actively driving this rapid sector recovery.
To summarize this whole rotation, capital hunts for the next expectation gap. Software rebounds rely on growth, profit, and cash flow. The software sector's recovery right now isn't just floating on a narrative. It is being aggressively backed by hard financial delivery.
Moving on to Section 4, Platforms, Lithium, and Data.
Looking at platform economics, DoorDash actually showed highly resilient demand. Their revenue grew 33%, yet their net profits actually fell by 5%. Why? It was due to a $50 million driver fuel subsidy caused by spiking oil prices. This perfectly shows how cost pressures dictate actual profit quality. Meanwhile, over in the data center space, FLNC jumped nearly 40% just on a narrative, but crucially, they failed to raise their actual financial guidance. An unrevised full-year outlook severely limits the lifespan of a purely narrative-driven rally. Now in the commodities space, lithium giant ALB has strongly rebounded from extreme cyclical lows. They just posted a staggering $319 million in net profit for Q1. For context, that's up from just $49.3 million a year ago. They also generated $248 million in free cash flow and paid down $1.3 billion in debt. This incredible fundamental recovery is being heavily driven by the new narrative of energy demands for data centers. And this brings us to a very fundamental buy-side rule for commodity stocks. True cyclical turning points require simultaneous price, profit, and cash flow recovery. ALB is demonstrating exactly this kind of fundamental improvement, shifting the industry right into a new cycle of prosperity. Let's explore Section 5, FinTech, Credit, and Utilities. When you're comparing AI credit companies, the funding structure is what dictates the actual quality of their fundamentals. Take Apaya. They use a locked-in funding model, meaning they have abundant funding and an asset-light structure, so they don't carry heavy risk on their own balance sheet. Upstart, on the other hand, relies heavily on bank partners. That means they end up absorbing massive credit risk directly onto their own balance sheet during rate hikes. The competitive moat here isn't just the AI algorithm itself, it's the funding source and the risk transfer capability. And then we see a really fascinating paradox when it comes to utility stocks like VST. They achieved a massive $1.03 billion net profit, driven by record U.S. power demand, and capital investment in infrastructure is absolutely surging right now. Yet despite this incredibly strong underlying demand, their valuations remain strictly capped. Why? Because strict government rate regulations prevent them from easily raising prices, and high interest rates suppress their valuation multiples. Strong demand is literally only half the equation here. Finally, Section 6. Let's synthesize all of this data into a comprehensive three-part buy-side evaluation framework. For institutional and retail traders trying to objectively map forward returns, we use three distinct pillars. Step 1. Assess liquidity and gamma. You need to monitor for the fading of crowded semiconductor call options and the rapid shift towards software. Step 2. Evaluate odds and win rate. You have to balance the long-term win rate provided by AI earnings upgrades against the thinning odds caused by short-term euphoria and technical resistance. And Step 3. Determine path scenarios. You absolutely must plan for multiple paths: a strong rotation where megatech takes over, a neutral path where the market cools before CPI data, or a risk path dominated by geopolitical negotiations and oil volatility. And that leaves us with this final, crucial thought to weigh before making your next move. The danger isn't a strong market, but mistaking sentiment for probability when odds thin. So, taking a look at your own portfolio right now,
Are you trading based on hard, objective data, or are you just riding the euphoria? We'd love to hear your thoughts, so let us know in the comments.